Welcome back from our short break. I hope you're feeling refreshed and energized. We're going to start with our next session now, which is going to focus on impact investment. So we all know that in order to reach our climate and energy goals in equitable and in sustainable ways, the way that capital distribution works also has to change. And we've seen more and more examples recently of how impact investment in social and environmental startups and areas is increasing, so how capital and social and environmental change can really go together. Where are investors willing to put their money today? That is a question that the next panel is going to address. And here to moderate this panel is Sissel Hansen, who is the CEO of the Startup Guide, and her books focus on impactful startups, which is why she's the perfect expert to lead this discussion. Over to you, Sissel.
Thank you very much, and thank you so much for having me here. I'm calling in from Denmark, rainy Copenhagen. I don't know how the weather are in Berlin, but thank you very much for having me. I'm gonna be leading this conversation about exactly what you say, impact investing, and especially focused in the energy sector as well. So for my panelists, I don't know, I cannot see them on the screen right now. I guess they will come in soon. But first, I would just like to quickly introduce myself. So my name is Sissel Hansen. I'm the founder and CEO of Startup Guide. Startup Guide is known as the Lonely Planet for entrepreneurs. We have created more than 50 books for different ecosystems around the world, exactly focusing on impact entrepreneurship and impact investing as well. And what we think is very interesting is this area that we are going into now, where the measures of what you would invest in is changing, and there is still not really a set of structure and standards yet, and that's why I definitely think that this panel is going to be super interesting, discussing this, how different investors are doing it, and especially focusing on the more green tech, the energy sector, and how impact investing and entrepreneurship in general can actually move the needle when it comes to the climate challenges that we see in the world. But I would like to start introducing our panelists. Hi, there you are. Good to meet you all. I couldn't see you before. So welcome. I think I will start with Danijel, climate tech investor. Would you like to give the audience a quick introduction about yourself?
I'm a climate tech investor at Ecosia. We are building a venture capital fund that will be announced next week. And yeah, basically we have recognized that there are huge investment gaps in climate tech, especially in Europe, that have to be filled. I mean, the DENA, Deutsche Energieagentur, brought out a paper 2 weeks ago only, addressing the investment gap in venture capital being more than 22 billion solely in Germany. So there's really a lot of space for many venture capitalists who are focusing on venture capital, and we want to help to fill this investment gap. So next week we'll be announcing the World Fund built out of Ecosia, the search engine that is planting trees, and I'm very much looking forward to this discussion.
Thank you so much, Danijel. And great, looking forward to hear what's going to happen next week. That's a good teaser for the audience as well. The next one I would love to give a small introduction is Moritz Jungmann. He is an investment principal in Future Energy Ventures.
Yes, also hi to everyone. Thanks for having me. I'm investment manager at Future Energy Ventures, which is the single LP fund of E.ON. Yeah, we have been investing in the climate tech space over the last 5 years under the umbrella of E.ON and Innogy, now combined forces under the name of Future Energy Ventures. For now, I think impact investing has been or can be seen in a couple of our investments, but we are also raising a new fund for the next year where impact investing, especially in the energy transition, will be much more focused. Looking forward to the discussion and seeing where this space is moving.
Thank you so much. And then I think we might have, is it Dr. Laura Marie?
Sure, I can go next. Yeah, hi
yeah, I think we're missing one. Hi.
Yeah, exactly. I'm dialing in from Switzerland today. Thanks for having me, guys. Great to be here and share insights also with other energy and climate tech obsessed investor colleagues and friends. So my name is Laura Marie Töpfer. I'm a partner at Extantia, a climate focused VC firm. For those of you who don't know Extantia, so we invest in technology innovators with gigacorn potential to move the needle on the KPIs of the climate crisis. So what that means essentially is, one, those with the potential of slashing carbon emissions at scale in the gigaton range, and second, doing so profitably, so with unicorn potential through scalable business models. We invest in early stage tech companies and climate focused fund managers, so mainly in Europe and North America, but really are what we're probably most proud of is that we've baked climate impact into the core of how we make investment decisions through our own climate measurement and reporting methodology that we've developed with our in-house climate scientists. So in our first fund, really, we invested into a portfolio of high impact climate tech companies, both in terms of the financial return they're generating, but also in terms of their potential to slash 5.6 gigatons of CO2. So now raising our second fund, where we hope to multiply this impact at an even larger scale. So yeah, really excited to be here and look forward to the discussion with the rest of you.
Thank you so much. Thank you so much. I think, do we have a fourth panelist, or this is it? I think this is it. I just have another name.
An additional one, yes.
Right, there is. It's just like that I'm not forgetting anyone that I cannot see. Good, but thank you so much, everyone. And what a panel! Great to really. There's one more coming in there. Hi, Bethany. Hi, can you hear us?
Sorry about that.
No
yes.
worries. Welcome to the panel.
Thank you.
Do you want to give a small introduction about yourself?
Yeah. Sorry, I don't know if you can hear me because I can't really see.
We can hear you.
Anyone? Okay, I'll just go with it then. Yeah, sure. I'm the investment manager at Bethnal Green Ventures based in London. We invest at idea, pre-seed, and seed stage, mainly into teams that are tech for good ventures, so that are scaling to positively impact the lives of millions. So yeah, happy to be here.
Great to have you here, and welcome to the panel as well. So we're going to deep dive into some different questions around exactly impact investing, and especially focused on this energy sector and so on. But before we dive into the nitty gritty, like, I would love to kind of start out with like having your take on what is actually impact investing and what is it not, right? So how is this different from more the mainstream investments, and especially when we're looking into the energy sector? I think also impact have become a buzzword over the time, and it's important that it doesn't, just become something we, sprinkle on so that the investments looks better. So I would love to guys hear what you guys think it is, and definitely also what it's not. I don't know, Daniel, do you want to start out?
Yeah, would love to, because I think in terms of climate, it's pretty easy to define what impact is, what climate impact is. It's everything that is able to reduce greenhouse gas emissions. And it's easy because when we look at the climate crisis, what's the reason for it? It is those emissions. So everything that can reduce those emissions on scale, is something that we consider to be climate tech. So we are only investing in technologies that are able to reduce emissions of at least 100 megatons per year. And I'm super curious also to hear from Marie how you think about it, because I also know you guys from Extantia. I pretty much expect you having the same perception of what climate impact is.
Do you want to take it?
Maybe the first thing to note is maybe, it's sort of become the nightmare word for every investor. Impact is sort of the dirty word by now. And rightly so, it's a fragmented alphabet soup of terms, lots of words that confuse really more than they help. And so I think maybe taking a step back is hopefully is quite useful. So ultimately, right, impact investment, it really is about that explicit intention, right, to drive an environmental or also social outcome or change. And so, I think as Danijel said, you don't only report and quantify financial return, but also return on impact you generate as an investor. So, for example, that could be carbon footprint by X units reduced, but that could also be other things. So it's not only focused on the kind of usual common metrics such as CO2 emission reduction, but also supply chains are relevant. I think the second layer to it for me is also maybe defining it in relation to what it's not. And so some of you, probably in the audience will have heard also about ESG investing and SRI, so socially responsible investing, environmental and social governance investing. And so really here, the key point to note is that what impact investing isn't, right, is in a way, if you like, a do no harm risk management tool layer where you don't really try to actively shape the management and governance of the company you invest in towards the outcome you want to drive. So whether that's a low carbon future or whether that's other objectives, that is, I would say, the key difference to other more traditional approaches that we've seen floating around. I think the final point for me to add here is that what you often see, right, and more, especially in the energy space, mainstream investment approaches, is that assumption that impact and financial return are somehow independent variables that you can't maximize at the same time, which is exactly where impact investors play such an important role, right? By baking impact into the core of a company's business model, you actually drive superior performance. So for me, the litmus test always is, if you assume the most evil company were to acquire a startup or a scale-up, would that change their impact mission? If the answer is yes, then probably it doesn't have impact at its core.
That's a good one. Definitely also what it's not as well. What do you think, Moritz? From your chair, what is impact investing and what is it definitely not?
Yeah, I have a little bit of a problem with it, I think, because in my view, impact also had or always had a social component to it. And now there's a convergence between impact and technology investment. I think all of us are much more focusing on the technology side of things. And because there is a high demand on climate tech, we all do impact investing now. But in the end, we do it because we can make a financial return with it. And of course, we bake it in and we try to keep it. I mean, we try to push the management and try to make a difference here. But in the end, we are still, most of the funds out there are looking for financial returns. And this is now possible because there is such a push with the climate change topic. And therefore, I believe it is not fair to the real impact investors out there that have been doing it over the last years, where financial returns are much more difficult to generate, where Maria, you're saying it, looking for gigacorns, looking for unicorns. This is very difficult to actually achieve if you're mainly looking at driving impact somewhere. So here I'm a little bit more, I'd say, concerned about this convergence.
I guess it's also right the time horizon that you're looking into, right? Like what is the return of investment and in what time? From your chair, Bethany, like how do you in Bethnal Green Ventures look at this?
Yeah, I think that there's an interesting point around scale in any case, right? Because at the scale that we hope our ventures get to in a short period of time, we think a lot about unintended negative consequences, because they're bound to come up, no matter what you're doing, really. So I think that's one area of impact that is obviously challenging to measure, and something that we work with our founders closely on. But that's one thing. On the time horizon in general, I mean, we have a bit of a different fund structure, so we don't have a typical sort of LP 10-year fund time frame, so we can be a little bit more flexible around our capital. But we do still expect teams to be scaling very, very quickly. So yeah, as I said, there's a lot of impact that we don't necessarily know, because there's so much for us to learn. Like, so many of the areas that we invest in are unproven. We, are still going off a lot of hypotheticals and that kind of thing. So, there's a certain amount of, I suppose, humility in investing in tech for good that we take on, because there's still a lot that I think we're learning as we go, if I'm totally honest. So yeah.
There was just a mention on the ESG and the social component as well. Like, I would love to hear Danijel just quickly from being mainly focused on green tech and climate challenges. How important is the social component as well when you guys look into these investments?
It is pretty much important, and this is exactly what I wanted to talk about now. I mean, we've been super much inspired by the book of Project Drawdown that came out in 2018, where there are analyzed 100 solutions how we can reverse global warming. And among them are also a lot of what you would first consider as social impact solutions. So it's about women empowerment. It's about getting the poor out of their situation. So, but basically it's all climate tech related solutions. So that's also very pretty much something we learned out of the book. If we really want to tackle the biggest social issues that will come up, and the climate crisis will get more severe, more extreme. Until 2050, warming will increase. We can do a lot against the climate crisis, but it won't change too much until 2050. So if we tackle the climate crisis and reduce greenhouse gas emissions, will help. It will also have a huge social impact. So that's also one of the reasons we are talking about measurement. So social impact is super difficult to measure, and comparably easy it is to measure the potential greenhouse gas emission reduction potential. So we really focus mainly on the greenhouse gas emission reduction potential when deciding if to invest into a technology and solution or not.
Okay, so that's interesting, because that brings me to the other investing, and how do you, I know it's a bit subjective, but if you can tell us a little bit how you measure it, and also what is like the major or the key benchmarks that you look into, right? You says that well, also because it's potentially easier to measure emission, then that's what you do. But what about sustainability, inclusion, equality, and all of these things?
Yeah, so basically we have two steps that we take. First, it's super difficult to precisely forecast what climate impacts a startup will have. So we are using two tools. The one is the Crane tool, developed by Prime Coalition and others in the US. It gives us really a rule of thumb number, and so we can really assess it has the potential to reduce 100 megatons of greenhouse gas emissions per year or not. And there's also a open solutions platform created by Project Drawdown. And then the second step we do is to connect those top down with some bottom-up assessments. And herefore, we use the network we have with Scientists for Future and with the TU Berlin. And at the end, we have something like 20 pages, basically, of assessment of the potential climate impact. We call it the CPP, the climate performance potential of each startup we consider to invest in. And we come to the conclusion, either we go in compared to other solutions who may be stronger, or we don't go in.
Okay, interesting. Laura Marie, how do you do it?
Yeah, I think that really resonates, Danijel, also in terms of, of course, this point on how precise can you really be, right? So I think maybe give you a quick snapshot of how we do that at Extantia. So rather than focusing on isolating individual impact benchmarks or metrics, we sort of adopt problem outcome first approach. So essentially what we want to make sure is that we focus on solving the big problems that matter to tackle the climate crisis by 2050, right? So essentially that leads us to focus on two things, if you like. So the culprits and the heroes. And the culprits we really see are, as the kind of sectors where the vast majority of emissions are actually coming from. So to achieve that, we want to focus on technologies that help us change how we generate energy and heat, how we grow food, right? How we move around, how we build houses. So let's say if a startup is working on a sustainable fuel solution, we know the transportation aviation markets. And so even before we invest into a company, we know their carbon TAM, right? So their carbon total addressable market. The second point here maybe to mention is that, if you think about it, right, at least 1 trillion tons of CO2 emissions, so that's 1,000 gigatons, will need to be removed from the air over the next decade or so. So we're also looking for the heroes, if you may call them that. So those emerging industries such as direct air capture and carbon removal and utilization that support those biological and chemical processes that absorb and store carbon, right? So our oceans, our forests. So these are, a bit like what Danijel said, these are top-down calculations, right? We then, in the second step, then feed this into how we bake climate measurement into how we make company-level investment decisions. So rather than, this is again the difference to ESG, I would say, rather than ticking some boxes at the end, right, when essentially you've already made an investment decision. So we do this through our own climate measurement and reporting tool we call EPIC, so Extantia Projected Impact Calculations, that we've developed with our head of carbon math from Cambridge's Sustainability Leadership Institute. The idea here really is to develop a life cycle assessment style methodology. So we look at the company's entire life cycle and project its time to impact. Now on the challenges, I think Sissel, that's sort of the key question, right? Because one can be talking about different methodologies day in, day out. Ideally, those projections meet the 1 gigaton emission reduction potential over time to reach gigacorn status. But yeah, so the point is, what's the interesting thing about those carbon projections? They're wrong, right? Because whatever assumption and numbers we come up with today is wrong because we don't know the energy mix of the future. So, investors like telling the story. I know who the winners in energy and climate tech will be when the science actually tells us it's wrong and at worst, greenwashing. So for us in our EPIC framework, it's not about getting the number precisely right, but getting the order of magnitude right? So we're actually able to track it transparently and scientifically, which is why we always work with minimum thresholds that do have an impact. So 100 megatons in our case for areas that are maybe still underexplored, but equally vital for a low carbon future. So why do we do that? Because ultimately that way you can make sure that each company trajectory addresses a big market problem to really move the needle on the climate crisis. And B, make sure that whatever trajectory that is, right, whether it's exponential growth, whether it's linear growth, it's traceable, it's rigorous, and it's scientific. So ultimately, bottom line is, right, I think this echoes Daniel's point. it's very hard in an environment such as the startup world, which is dynamic and fast evolving, to put a precise number on it.
I think one of the things that we often hear when we interview startups is also the difficult thing that all investors use different methods and methodologies and standards and so on. Is that something that resonates with you as well? Like from our perspective, we definitely see the ESG becoming like the standard. But it is of course difficult when this method have mainly been made for, the companies with a bigger track record. Like I would love to hear from both Moritz and Bethany about is there a challenge when you actually talk with the startups about how they actually can be part of bringing this data to the table that you need to have in order to invest in them?
Yeah, and maybe to start, and I mean, we haven't started with our own impact measurement approach yet, and we're still trying to figure it out and trying to, of course, also find best practice. But looking back and how we manage our portfolio and how much work we already put in our reporting as such, I think it's going to be also a big question of how to implement that into processes that we already run, and how much effort can we actually put into it, and how much feedback do we actually get back from the startups. So it always depends also on your shareholding, on the communication you have with the startups, and also on how they have to develop. If you do pre-seed seed investment and they look way different, or there are different developments within the company, this is going to be very difficult to really follow up with all the time. So I think it's very important, if we look into the future of this, that we don't do greenwashing monitoring for ourselves. So what are we really reporting on, and does it really move the needle, or do we have to maybe report on a more high level scenario for our fund itself and see what happens over time? And I'm totally with you that it's going to be very difficult to predict, because we are in an area where everything is still changing, and therefore, yes, I believe that the operational part in the transition of the theoretical methodology putting into the daily work will be very difficult, and we will need to develop some kind of blueprint to ease this kind of process for everybody to also compare their efforts.
Okay, that's interesting to hear. Bethany, from your perspective, measurement standards, benchmarking, how do you tackle that?
Yeah, I mean, I definitely echo a lot of what's already been said around things change so much as teams go through the different stages. So, and we also have the challenge where we're not just investing in environmental outcomes. Like a very large part of our portfolio is in digital health. We have a portfolio that goes across so many different sectors. So as much as we're a tech for good investor, we're sort of generalist under that umbrella, which makes being a really effective, putting in really effective measurement can be challenging across the portfolio, because there is varying proxies for success across the different spaces. So I would say that's one challenge that we have. But our impact framework and the way that we think about it when we're making follow-on investments, for example, which is when we really kind of like dive into the team's impact, is we defer to the team quite a bit around how they're thinking about it and how they're measuring, particularly in like very specific spaces. We think that, there's external experts that we can call on and that sort of thing to support us in measuring. But generally, I think that there's, we want to understand how how deeply their solution is really tackling the problem, because I think that can be a common challenge, is understanding early on, even pre-seed, seed, and then Series A maybe is like your first instinct as to like, is the solution actually working? So we have to kind of have conviction with very little information, very little data. So what we end up doing is going like smaller but deeper. So we speak to like the exact users, if it's B2B, like the specific customers, to understand like early signs. But because we're so early, we're such an early investor, we invest without a product, without anything. We do have to defer to the team quite a bit, that they are owning their sort of measurement and impact.
May I add one point that I think is super important, why we have to measure potential impact of startups, even if it's difficult and early. It's out of two interests. So the one is we want to make sure to invest every euro as efficient and effective as possible to reverse global warming. And the second thing is, and it's totally our thesis, we hardly believe that those who will make the biggest climate returns in future in terms of saving emissions will be those with the highest financial returns. So we also, in the interest of our investors and ourselves, out of our financial interest, want to make sure to make the best investments here, to have equity in the most valuable companies of the next decade. So this, even if it's hard, it's super important to have a framework. And this also with Extantia, we're also working together because we are all in front of the same problem. We have to quantify something what's super hard to quantify, but we have to do this effort to make sure to reverse global warming and to return a lot to our investors.
All right. That well, when you say it like that, makes a lot of sense as well. When we look now at the energy sector, which is kind of the most popular right now for impact investors, based on your own metrics, which technologies really are taking the spot when it comes to impact? Is there, well, both where impact and profitability meets?
Oof, that's a tough question. I don't know. I think I would reverse engineer this a bit, maybe. I mean, if the outcome that we kind of care about is like energy transition and net zero economy, right, by 2050, I always think it's helpful to look at the latest International Energy Agency reports. I think the numbers are quite telling. Right? And what they say essentially is that most emission reductions, right, through 2030 will come from deploying existing tech that's available today. So your solar and your wind, for example. But in 2050, half of the necessary emissions will actually come from innovations that are still in the demonstration and prototype stage today. So you think about your hydrogen-based processes, for example. So right, that's actually an interesting first thing to realize, that we don't have a choice between deploying existing tech or innovation. Really, we need to make urgent progress on both sides all at once. So I think, Sissel, to your question, it's hard. I think it's helpful to first of all be clear about what is it that you want to drive. And as Danijel said, the key thing is to think of it, how are we addressing this issue profitably? How are we solving some of the KPIs of the climate crisis through technology profitably? So from an investment perspective, I think it's always important to look at it from the angle of which of these technologies can actually be commercialized and scaled quickly to actually get us there, and to slash, right, what Bill Gates calls closing the green premium, so the cost gap between choosing a clean technology alternative over, let's say, an existing fossil fuel solutions. So from an investment perspective, I think if I had to pick one area, and again, that's very hard because there's obviously various different investment areas that are promising, but I'd probably say it's solutions that address the intermittent nature of renewables, renewable tech that's already available, right? You can do this in two ways. One, solar and wind, so companies that are working on solving the intermittency issue. So think of long duration energy storage, or the gigantic batteries that will last for days, or even hydrogen related processes. And two, and this is where we're really bullish, is to actually move to a different base load of energy sources altogether. So we've been very bullish here on the geothermal side, but also sustainable fuels and hydrogen. I mean, let's be completely clear, right? These are high risk, but also high reward. And I think what's interesting here, if we look at this from a sort of top-down macro angle across the investor space, and different types of investors, what I think is really interesting is that I'm seeing a massive shift in willingness and also ability among investors to share that risk, whether it's your blended finance, government money, venture capital, or much larger scale financial follow-on investors. It really is changing, and I think important to note here, very different from what we saw in clean tech wave one, because of that maturity horizon.
Interesting.
Yeah, I
Anyone
think
else?
in addition to that, I mean, just out of our perspective, I mean, mainly focusing here on venture capital. I mean, most of our investment, let's say 99.5%, goes into software companies. So if we're looking at the mix of capital invested, then we will not meet the goals in 2050 if we maybe also don't shift more capital to project development and construction. So I think it's about 5% each of both domains. So we can work on a lot of more commercialization, on more efficiency, but if we don't get more green power in our energy mix, then this is not gonna turn out the right way. So I think it's always sexy to look for the moonshot projects, and always sexy to find this unicorn that really scales on low OPEX. But in the end, I think this is not gonna really move the needle into the direction where we need to be.
But I guess also like
this needs at the end more regulation. So there needs more government incentives that actually the money is, or the capital is, flowing into that direction.
Yeah. And I guess that's also like that. There is also a lot of low-hanging fruits before, right? There is still a lot of technologies that needs to be implemented and solutions that need to be implemented as well. Like, can impact investing play a role there?
As Marie said, I also have really a problem with this term of impact investing, because there's still this misunderstanding that something that generates impact cannot generate financial return. Although it's proven that it's totally the opposite is the case. Like there's the study of Cambridge Associates. They looked at startups out of the clean tech and climate tech space over the last 20 years. And you can clearly see that since 2014, in terms of IRR, so in terms of the returns you generate, the interest rates, climate tech startups are outperforming every other startup. And there's also this misunderstanding of clean tech 1.0. Those 25 billion euros or dollars invested between 2006 and 2011. Now those companies are worth more than 750 billion euros. So it's a multiple of 30. So that's really a good multiple. Of course, among them startups like Tesla and Beyond Meat and QuantumScape, etc. So sorry to refer, I'm really a bit allergic on the term impact investing, but definitely investing into technologies that can have impact and financial returns are the solution, are the answer. As you just said, Moritz, we really have to also invest in hardware, not only into the gorillas and e-commerce platforms of those days. Yeah, that definitely is a disbalance.
Thank you. I guess this has to be the last word. We are running out of time, as I can see here. I don't know if we have more time, if I hear anything, but other than that, I want to thank you all for taking part. It's an interesting discussion, impact investing or not, but let's get the financials out to to actually make, you know, a better future for us all. That should be the goal. But thank you, everyone. Thank you, Dina, for inviting us. And yeah,
Thank you.
back to you.
Thanks, everyone.
Thank you.
Ciao.
Ciao.
And thank you so much, Sissel, for the wonderful moderation of that discussion. I hope everybody who tuned in agrees that was really fascinating to listen to. So thank you also to our investment experts and for deconstructing the terminology a bit there. We have a short break coming up for you. So again, a moment to stretch and to grab a fresh drink. And we'll be back very shortly with our first keynote of the day. So do stay in for the first keynote coming up from GTAI.